All right, this is a very interesting strategy. Now, if you look at the data, now, as the market goes up, the MACD ranges move with it. So my question was, how many of the observations of the MACD were above minus 100 while the market was in an uptrend? 99.4%, which means that the closer the market approaches the minus 100 level, as long as it is above the 200, and assuming that it will not change its trend, then you have a lot of probabilities in catching the so-called bottom of the correction. So if the market is plunging, and your fundamentals say that its trend will not change, as the closer it gets here, the more confidence you have. And that statistical observation was the nucleus of one of my studies that are the strategies I devised on this one. Again, it's based on math. You just look at it, observe it, measure it, and then make it into a strategy. And what you're trying to do is have a whole bunch of them. So if something doesn't work, you have something else that works in its place. Again, 24%, blah, blah. Again, when you're in a downtrend, it's very symmetrical. 99.8% of the observations are up less than 100. Phew. Which means if the market still remains in a downside, if any reactionary rally that takes the market up to this level, short it. I'm not saying you take a mortgage, and bet on it, but the odds are heavily with you. So what you do, take one pattern, code it, and start looking across markets. 5 of them show this pattern, take a very small position in those 5, and then manage it. Have another 4 or 5 patterns, and that's how you do it. Rules-based trading instead of nowcasting, instead of forecasting. Again, with the Bund, same thing, statistical properties. Again, sorry if this is just too numerical, but this was presented for the paper, so it was shown to my peer, so I had to be, verify basically what I'm saying. Again, same thing here. Look at it. Very symmetrical. Very, very symmetrical. 99.8% of the observations. Again, for the Bund. Completely different market, different asset class, different fundamentals, different trends, different volatilities. The properties remain the same. Here is the chart of the Bund. And this is the oscillator. So one strategy that I use, and I actually do use it, is take the 200-day moving average. And when the oscillator is between minus 50 and minus 100, I prepare to buy. That's my setup to buy a correction. Simple as it may sound, but I've got stats behind me to back it up. And I look for this position across market. Any questions so far?
Can you repeat that?
Yeah. I'll be mentioning this in the workshop with more in the one we'll be doing 2 weeks from now. Costs £5,000. No, I'm just joking. Now, well, actually, if I did charge for it £1,000, it would be worth it, believe me. But it will be free. Again, based on this, market is above the 200 moving. Basically, what you're looking for this. The question is, how much can the market fall within its trend and have a meaningful chance of it rebounding? So that's the way to define it. Again, like I mentioned, these have been programmed, and I would be more than happy to share with this. Don't look for any, like I mentioned, super strategy. I will be mentioning it again and again and again. Simple and systematic. Just program it, test it. If it works, try to see if it does across market. Maybe slightly tweak it. Use a portfolio of such strategies, and then off you go. Focus more on research. So, strictly speaking, I spend more time researching rather than trading. I open up my platform, put on my orders, close it, and that's it. Again, we can, same thing with natural gas. Again, back 100%, 99.8%. Again, the observations when it's falling below 100. So this pattern, to put it this way, is this. To put some visual aspect of what the market does and how you can use it. Okay, so market in an uptrend. How do we define the trend? Again, use a 200-day moving average. So the question is, how do I buy a pullback after the market has had the correction? Not a retracement, but a correction. So if the market does this, what is the point when it signals you, now it's a good time for us to start getting in? Assuming, and that's a big assumption, that it won't break behind the MA, it will continue up. Now, this question is answered by the MACD. So if you got it 50, minus 50, minus 150, 50, 150. So that's the indicator. All right, so what you do is you have, first of all, you satisfy the first condition, if then, close above the 200, and as long as the indicator is, minus 100. It's in this area, between minus 50 and minus 100. So you can create a scan. If the market rebounds from here and it does this, instead of this, because we don't know this, we're trying to assume it through fundamentals and other, like I mentioned, it's a probability game. I don't know what the market will do. I'm just trying to figure it out in a more credible way. So if it does this, then look at that. Place that in a scanner and then off you go. Then you can start looking for it. And you can have, again, based on stats, you can start looking for corrections, pullbacks, breakouts, like we mentioned, when it goes above the 50. Will it work all the time? No, it will not. But what you're trying to do, apply it across markets, very small position size, and let the law of statistics work for you.